Greetings, everyone, and welcome to the February 2020 Investment Strategy Brief. We got a lot of content to cover today. We're going to move at a pretty quick pace, but as we like to do, let's get started with a look at the equity markets back into 2019 and then through into 2020. We all know the story of 2019, a bit of a roller coaster with a variety of things going on, trade tensions, etc., but ultimately ending the year very positive, and we'll talk a little bit more about that in a minute. And then 2020 in its own way is, although it's only been a couple of months almost, the same kind of thing, a little bit of volatility. And it's really been around the coronavirus outbreak and people trying to figure out what's going to happen with that. But, that's against a foundation of very positive data and sort of circumstance. One, good economic data release is still coming out, corporate earnings looking pretty firm, Fed signaling support, and some signs of containment of coronavirus, but again, we'll talk about that. Now, when we look back to the history of the stock market against different coronaviruses and other diseases that we've faced as a species almost, essentially the takeaway is that the market tends to persevere. And so, there is sometimes some volatility. Currently, it really is relatively light relative to the potential. And yet, I think the takeaway certainly from this slide is that it's best for investors to take a long-term focus and long-term approach when it comes to investing in the stock market. Now, the coronavirus itself, we've actually just published a piece, what we call Sightlines, about the coronavirus. This is a new virus coming from China. Mortality rate is a little below 3%, which compared to some historical coronavirus outbreaks is actually okay. It's better, essentially. And what's been intense about this one, though, having originated in China, is it's caused us all to focus on the role of China in the global economy. China has had a very fast-growing economy. They're now number 2 in the world by GDP. And again, we'll look at that a little bit later from a different perspective. But they also really are a key part of a supply chain, or the supply chain sort of for businesses around the world. And so containment of this virus is super important. Again, I looked at the Sightlines article and related content for that. So we always like to take a look at this, what I call our 3-column under the hood view: markets, themes, macro environment, headwinds and tailwinds. And, the bottom line here, again, is that we continue to see, looking forward, positive economic growth. We continue to see positive support from central banks, and we're anticipating the possibility of fiscal stimulus. So think lower taxes in places like Europe. In fact, what I want to do is take a very brief look at our 2020 outlook. We started in part by looking back at 2019, and you'll recall that our view of 2019 was really anchored on 4 resolutions: Brexit, U.S.-China trade, a good Fed policy, and the potential for bipartisan engagement in legislation. And obviously, we had Brexit occur. We had a U.S.-China phase 1 trade deal. The Fed's been very supportive. And while limited, little glimpses of bipartisanship in D.C. Not a lot, but a little bit. The net result of all that, of course, is that as we look back at 2019, there was sort of a support to the equity market driven by these things resolving over the year. Now, obviously, as it relates to where we see things going from here, the UK and the EU are now in a phase of basically looking at developing a trade deal. So they're going to take all of 2020 to try to do that, and that may create some volatility. We'll watch it. So with that trade deal done, what specifically needs to happen? Well, they need to negotiate a comprehensive trade deal. The whole idea is that during this period, essentially the UK remains in some ways part of the EU, but will disengage politically. Then that trade deal needs to be resolved through 2020. And again, as I mentioned, we expect some volatility as a result. Now, another thing that we focused on in our 2020 outlook was the concept of competition. And essentially, U.S.-China is a really good example of that. So as one example, there's a World Economic Forum measure that gauges competitiveness. And the U.S. is close to the top. I think we're number 2. China's a way down on that index, but they're kind of climbing. And, so what I think the point being here that we expect there to be sort of healthy competition in a variety of ways, but included in that would be sort of U.S.-China competition. And when we look, in fact, at GDP overall, as I mentioned a moment ago, U.S. is number one. We remain number one. But China, boy, they're catching up. And just by pure magnitude of GDP, they're number two behind us. And that's a huge change from 20 years ago. And so, I think one thing I'd say is that there's a forecast that China can surpass us, not in this coming decade, but probably in the 30s. So again, that's something we're going to watch, and both countries are going to compete hard along the way. Now, let's take a look back into the strong markets of 2019. Basically, it's a very, very good year. And most asset classes returned very positively, with sort of U.S. large cap stocks leading the way. The Russell 1000, for example, up 31.4%, and the S&P 31.48%. One of the things we like to do is to try to gauge how common a return like that is. And so while we can look back, it's only 12 times over the last 84 years that the S&P has posted a return like this. When we look forward using our sort of assumptions for the equity market, essentially we calculate that there's only about a 5% chance that the market should post a return at this level, 31.5% or better. So think of that as a 1 in 20 year event. So 2019 really was a bit unusual. And so again, just to sort of reinforce in terms of our 2020 outlook report and what we wanted to summarize here, we've talked about competition, we talked about U.S.-China. But overall, what we're calling it is productive competition, that there are these various dimensions of competition that are with us today, some of them geopolitical, some of them economic and sort of business-oriented. And the bottom line is we think they're productive because competition can make parties that are competing stronger. So again, that's an anchor to our 2020 outlook. Now, sort of translating all that to what it means for the economy and markets, we really recognize that the one thing we know for sure is whatever we anticipate is going to happen, we're going to be wrong in some level. And so as a statistician, the way to solve that problem is to say, look, let's actually define three scenarios. And so we've done that in our 2020 outlook. We have our base case, which is our most probable forecast, if you will. We ascribe a 60% chance to this, is that economic and earnings growth continues, but slower. We potentially see some positive things like fiscal support in Europe. The election may cause volatility, but ultimately we end up with a candidate and ultimately a president that is sort of business friendly, and things just continue in a positive direction. And against that, there are two other scenarios. A bull case, which is, hey, things really calm down. Maybe coronavirus in this environment really gets contained, and it's very clear in the election early that there's going to be a business-friendly candidate emerging, and maybe businesses just start to rebound both here in the U.S. and around the world, and markets and sort of the economy takes off a little bit. The other is, of course, the complement of that is the bear case scenario. We ascribe 15% to this, which is that things actually get worse. Maybe more geopolitical risks sort of emerge, or earnings don't come out as good as people expected, or maybe a quote-unquote business unfriendly candidate emerges as the leader. And, again, that could be good for people in terms of having different views in terms of platforms and programs and policies, but, the market may roll over if that were to occur. So one of the things we do for the election is we've developed a framework. We published about it last year, and through 2020 into the election, we'll just continue to publish and update and kind of comment on where things see things standing against this framework. The framework starts with timing, the 4 phases of the election. There's the early primary, late primary, general election, and post-election. And right now we're kind of, moving from the early primary into the late primary. We're staring down Super Tuesday in a bit, and that'll bring some definition to who the sort of key candidates are for the Democrats. But ultimately then we want to and continue to assess the various candidates for what we're calling their business friendliness. How will businesses and the stock market react to their candidacy? And then, of course, we're going to continue to gauge things like polls and other sort of prediction services to try to measure which candidates are ahead and what that means in terms of heading into the election and through the election. So again, an update as we go here. So, the bottom line is, as it relates to sort of the environment, the election is one example of geopolitics. And geopolitics, just in general, have started to really influence the way people are thinking, the way businesses are thinking, ultimately the way the economies might act. And so it's important for us to remain focused on it. In fact, at Stifel, we publish what we call a Geopolitical Dashboard. It's basically tracking a bunch of geopolitical risks that we think are important to monitor. And we gauge both their likelihood and, if the event were to occur, the impact on the markets. And we've actually updated this just recently from two perspectives. The first is we used to have a comment about Brexit and the likelihood of Brexit or not happening. Of course, it did happen, which is great. So that specific risk is behind us. But now we've recast that to be about the EU and the UK actually developing a trade deal. So that is by no means a done deal. And so that is the new way that we're sort of gauging and evaluating that risk. The second thing is that we did introduce the idea of coronavirus and a pandemic that might come from that as a pretty important risk to track, in part because to the degree that countries are shutting things down, travel, or China's shutting down travel even within the country, that's basically negatively impacting supply chains, and that can be a bit of a headwind for the economy. So, it's important to recognize that. Now, the other thing that we have in that dashboard we've had for a while, as I've mentioned before, is the U.S.-China competition, where that's evolving. And, so again, we're continually sort of tracking and watching China and the U.S. and how we're competing. Now, in the Outlook report, we also had sort of a quick summary of our Stifel Financial ID. It's our behavioral finance model. The spirit of it is to say, look, we want to help our clients understand the nuances of how they make decisions and what's most important to them. And, examples would be risk attitude, which is pretty traditional, but also composure, the idea of how well will a client take, how well will you take the market rolling over and your portfolio losing money. We can gauge how that will feel for you, and that may influence the way we help you invest. So again, the idea of Stifel Financial ID and using behavioral finance to inform investment strategies is pretty important. And then finally, in the Outlook report, we also have sort of a reference to Stifel guidance. It's basically what we publish, when we publish it, and where to find it. And so hopefully that can be helpful to you looking forward. Now, turning to the macro environment, and again, I think of this as a more sort of traditional view of what's going on in the markets, and we're going to just sort of repeat this with each investment strategy. But if we start with a consumer, basically tracking a variety of things that relate to the consumer and the consumer's role in the economy. And to cut to the chase, as it relates to the consumer, things have been very positive. So we see things like very robust, strong confidence measures. Of course, we're sitting in a very positive job market, and we're going to talk about that. And then that translates to things like strong retail sales. So the consumer, a really big part of the overall economy in the U.S., has been strong. Housing, a much smaller part of the economy, has been positive but more mixed. So the data by its nature is more volatile, but of late, two measures that have come out that have been positive. One is home builder confidence, so just sort of surveys on how home builders are feeling, and then housing starts, which have been strong. So again, there's some volatility to the data. Sometimes we see some negative numbers, but the net is sort of modestly positive. And that sort of framing of net modestly positive is also true for business. It's, in this case, a little bit more mixed results, but in the aggregate, we're seeing positive data and we're seeing a little bit of momentum. So things like small business optimism, which remains very, very positive, and then what are called the Purchasing Managers Indexes, PMIs, are also generally positive. Those are basically surveys of business folks, both in manufacturing and services, on how they see things unfolding looking forward. And those, especially in manufacturing, kind of came down a bit, and now they're on a bit of a rebound and are signaling net expansion. So again, mixed results in terms of business, but generally positive. The next section is inflation. This has been very interesting because the Consumer Price Index, kind of a classic measure of inflation, has actually popped up a bit, especially when we look at the general CPI. And sort of year over year, it's above the Fed's 2% target. That actually just happened as well for the Producer Price Index, what's called the PPI. The most recent print basically showed a one-year number, I think 2.5%, which is above the Fed's 2% target. But these charts show that there are a variety of inflation levels inflation measures that the Fed, for example, will be tracking, and quite a number of them are below the 2% target. So we've called for inflation to come up, maybe settle a little bit above the Fed's 2% target. We think they'll tolerate it there since it's been below for so long. But inflation, of course, is something that we're watching carefully. And we also try to understand how the Fed's thinking. So we also like to share these 4 factors that we think the Fed is monitoring, things like inflation, things like employment. They've got their GDP model out of the Atlanta Fed showing positive growth, and then conditions, financial conditions. And, again, everything here is sort of pointing to things being in a decent spot for the Fed to stand pat. Now, when it comes to employment, this is something that's been super positive in the environment. So this next chart just basically captures 4 key measures. Unemployment, which remains really pretty close to a 50-year low. I think it's just 0.1% above. Job creation just remains very robust. Jobless claims remain low. And, things are just, just generally positive in terms of the employment market. So we wrap all this up in what we call a recession checklist. And, so the idea is we have these 13 different measures we're watching, and we are either viewing the measure as positive, as cautionary, or really firmly signaling a recession. And the bottom line is we have 3 of these, as you can see on this chart, that are sort of a little bit cautionary, things like the yield curve or truck shipments. But the bottom line is, overall, we think the economy, for the near term especially, remains pretty positive. So we don't see a recession on the very near-term horizon. Now that's important. If we think about the economy, we've talked about this, time and time again. The economy will, by its nature, the way it operates today, will occur in cycles. There's long periods of expansion interrupted by short periods of declines, or what we call recessions. And so obviously in the environment, we've been in this expansion for quite a long time, and we basically have to watch for that recession. And so far, again, in the current environment, we are not seeing it anytime soon. What's also interesting, of course, as we've discussed before, is that stocks follow suit. In some ways, stocks are a leading indicator to the economy, but the bottom line is the stock market operates similarly in these long-term cycles, bull and bear markets. And just like the economy, this latest expansion has been very strong, very long, and we're very late cycle. So I think everybody in our business is really focused on where are we seeing cracks, and are we going to see the market roll over. So we actually have a what we call our bull market checklist, a variety of things that we're looking to see that are sort of sometimes indicators that the market may roll over. And as you can see by this chart, across all the things we track, we're not seeing anything from this perspective that's signaling trouble as it relates to the equity market. So again, that's what we see in terms of the bull market. Now let's go to the environment more generally, and specifically in the market environment, starting with rates and spreads. I think of it as building up from cash rates to bonds to the equity market. Right now, as I think we all know, yields have fallen across the yield curve. They came up a little bit early in the year. They've come back down a little bit. In the current environment, while the curve flattened some, it's now back to a slightly positive spread between 10s and 2s. This sort of the environment as it relates to corporate spreads look reasonable. They had sort of tightened up, sort of coincident with the equity market going higher. We think they may widen out a little bit, but not in any dramatic way. So again, things are looking pretty good. We wanted to take a special focus this month on duration. And remember, duration, the concept of that is for a particular bond index or a portfolio, your portfolio. Duration gives you a sense for how sensitive the portfolio or the index will be to changes in interest rates. So if interest rates go up, prices go down, and the magnitude of that is a function of duration. So what's interesting is that duration for the kind of overall market, with everything except high yield really, has lengthened. And it's really driven by 2 things. The first is just by the mathematics of it. When interest rates fall, duration extends a little bit, everything else being equal. But the other, probably more interesting thing is companies recognizing that we're in a historically low rate environment. So on average, they're issuing longer maturing bonds, which will extend the duration in the market. So again, when we're working with clients, of course, this is a key factor that we're considering as we invest in the bond market. Now, I mentioned our bull market sort of checklist is looking pretty positive. The one thing that we continue to watch are what are called equity market valuations. And this is typically PE ratio. There's others that we look at, but this chart shows PE ratios both here in the U.S. and outside the U.S. And the bottom line is by this measure, valuations are pretty high compared to historical standards. And one of the things, for example, we've observed is that's more true in the U.S. than outside the U.S. And it's actually caused us to make a change in our equity thinking, which we'll talk about in just a minute. Now, what about earnings? So a key anchor to the equity market is earnings. And as of sort of reporting this, doing this video, 71% of the S&P 500 companies have reported earnings that were better than consensus. So those that have reported, 71% have reported earnings better. And that's sort of in line with the last few years. It's just been this environment on average of modest positive surprise. And as of this moment, the consensus earning growth for the full 2020 is about 8%, which is a pretty good number. Now, another thing I want to briefly focus on is a new body of work from our team and from our firm, which is really a fairly formal assessment of U.S. equity market sectors. And these are sort of developed against primarily our base case outlook. And what you can see here is that we're overweight communication services, financials, and material sectors, and then correspondingly underweight consumer staples, real estate, and utilities. And the spirit of this is it's not that every client follows exactly this guidance, but sometimes people will either want to understand what we think from a sector perspective or sometimes invest against it. And so we've created this new body of work and a report separately, and probably video will be coming out on that shortly. Now, as it relates to kind of wrapping all this together, kind of our 2020 outlook, the thinking behind that, the current market environment, et cetera. This next slide just basically summarizes our forecast as of the beginning of the year. What did we see a couple of months ago? As mentioned, we see inflation increasing a little bit. That corresponds to us believing that GDP will remain positive. We see volatility increasing slightly, especially against the subdued volatility of 2019. And in the equity markets, we're basically seeing sort of high single-digit returns, which again, we've almost in some areas already experienced, but as we're seeing, it's kind of volatile. So again, modestly positive from here is probably how to think about it. And then that's sort of all supported by the Fed, and we think them being ready to act, but just given the environment, we think they're going to stand pat. Now, just to remember how we translate all this to investing for clients, our asset allocation framework is one about choice. We give our financial advisors and out to our clients, sort of a body of work that allows people to go and grab and understand things that are helpful to them as it relates to how they like to invest. It might be their risk tolerance. It might be their preference to buy municipal bonds versus taxable bonds. They may want to be more globally oriented in the equity market or more focused on the U.S. And then many clients take a strategic approach, which means, hey, let's set up a strategy and let it sit for the long term. But then some like to invest against that more dynamically. Where do we lean against those long-term allocations to try to either protect value or earn a little extra return? And so, we think that's a helpful framework. So what does it mean then to wrap it all up here in terms of and this work that we've done and what it means for our dynamic leanings? Essentially, in the U.S., we're overweight value, and we've been that for a while. We think the large cap value space will recover at some point here, and we want to be positioned for that. But interestingly, what we've decided to do because of those valuation differences is go a little bit overweight non-U.S. equity. So we're overweight non-U.S. equity in place of U.S., just a little. And then outside the U.S., we're also overweight Europe. Now, when we look to the fixed income markets, what are some of the things we're focused on? I mentioned duration being a key sort of way of measuring interest rate sensitivities. We think interest rates are going to rise up a little bit. So we're just modestly short duration, meaning take a little bit less of that risk, given that we think rates are going to go up. We have an allocation to TIPS, which are inflation protection securities. And then as it relates to high yield, we're basically at our strategic weight. So we're not overweight nor underweight as it relates to high yield. Now, we always like to close to remind ourselves and the viewers of our long-term themes. So we remain focused on the fact that we're late cycle, both the economy and the markets. And so things like central bank policy, all of that is going to be super important. We've identified themes like millennials and how will millennials, this sort of next generation coming into power, will influence businesses and the way the economy works and ultimately the markets. And then, as I mentioned in our 2020 Outlook, we created this new long-term theme we were calling the Decade of Productive Competition. So whether it's US, China, or other things, even the political environment today, we're in a highly competitive world. And what we like to think is that ultimately translates to productivity and sort of making us all better over time. So listen, thanks so much for listening and viewing this month's investment strategy brief. And we look forward to speaking with you next month. Thank you.